Hello, welcome to the first ever installment of the Established ESOP Forum. We designed the Established ESOP Forum to support you as you lead your companies through the many phases and stages of implementing and managing an ESOP. While this is the inaugural event, we plan to roll out additional installments so that you can benefit from regular insight and connection with professionals who can help you with every aspect of the ESOP journey. After our panelists have spoken today, we're going to have significant time for Q&A. The goal of the event is to provide high quality insight, so your specific questions are definitely welcome. You can submit your questions through the chat feature, which the moderator and panelists will be able to see. As a reminder, this format does not include video or microphone for participants. This means that other attendees and panelists cannot hear or see you. Questions and comments placed in the chat are encouraged. At the end of the Q&A, we'll ask you to give us feedback on what you thought of the event and how often you think you might want to engage in content like this to benefit your company's ESOP. First, I want to introduce myself. My name is Jeff Jamerino, and I am the Director of Post-Closing Services on behalf of Lazear Capital. And I want to take this time then to also introduce to you our panelists today who will be serving with us over the coming months. We designed this panel to provide a 360-degree expert view on any ESOP question or topic. So each panelist represents a unique and important perspective from the key aspects of law, valuation, trusteeship, and plan administration. First is Kristy Britsch. Kristy is an attorney in the corporate group at Levenfeld, Pearlstein, with a focus on ESOPs and general, ERISA, and executive compensation matters. She has more than a decade of experience advising closely held businesses on incorporating ESOPs into their business succession planning. Next is John Prodoehl. John is the VP of ESOP Consulting at Principal. He has over 30 years of experience in the retirement planning industry and has extensive experience concentrating on clients with employer securities in their plans. His areas of technical expertise include ESOP consulting for existing ESOPs, as well as ESOP transaction design and consulting for companies exploring an ESOP. Next is Corley Thomas. Corley is a managing director with HDH Advisors. Corley's experience focuses on providing a wide variety of valuation and transaction support consulting services for the purpose of financial reporting, tax planning, contemplated M&A, and general business planning. He has significant experience in performing equity and enterprise valuations, debt valuations, and complex deal structure consulting. And our last panelist is Neil Brozen. Neil is the president of Ventura Trust, serving as a trustee for many ESOP plans. Neil co-founded Ventura in 2016 after working for two institutional trustees since 2005. He oversees the relation management team at Ventura and with responsibility for more than 140 ongoing clients. In his career, he has been responsible for more than 400 ESOP transactions, including new formations, second and third stage purchases, third-party sales, termination and redemptions, refinancing, and releveraging. Today's topic is demystifying ESOP repurchase obligation, crafting a plan for the future. RO, or repurchase obligation, is critically important to the ongoing success of ESOP companies as they mature. The RO must be studied and planned for in order to avoid the pitfalls that have caused havoc for unprepared ESOPs in the past. With that, let's start right in with some questions for our panelists. Kristy, I'm going to start with you, and if you wouldn't mind, briefly tell us what is repurchase obligation?
So repurchase obligation, and I guess I'll before I get into what that is, I know most of the attendees are newly formed ESOPs, and so you probably heard this term thrown around in your ESOP negotiations and wondered, why do I need to worry about it now if this isn't something I need to do down the road? And as you're going to learn, it's very important to manage this early in the process. And all of you hold what we call privately held employer securities. So your stock is not on the, it's not traded on the stock exchange. If somebody gets a stock distribution and a stock certificate, they can't go use that to get money. So you are your own market. And what that means under repurchase obligations is essentially it's the employer's way to make a market for the privately held securities that are held within the ESOP. So what does that mean? Well, and the IRS actually mandates this, and I know Neil's going to talk more about this, about who's kind of responsible for this obligation study, but the IRS mandates that the employer make sure that the ESOP, if the ESOP is going to be paying out cash, has cash to cover vested account balances upon a distribution event. So when somebody leaves, they're entitled to a distribution of their vested account balance. The employer has the obligation to make sure there is cash to pay that. We also see this in diversifications. Again, you newer ESOP companies, you don't need to worry about diversifications in the immediate future, but as you mature and grow, diversification is another area where it triggers the repurchase obligation. So another sort of distributable event to keep in mind as you plan. This obligation, or the liability, the repurchase liability, it's basically ensuring, so not only do you have the obligation to make sure there's cash to satisfy these payouts, these distributions, but you also want to make sure that your participants are realizing the value of the stock. If there's no cash to pay out stock, and these people, as I said, they can't go use that stock certificate or stock to have somebody else buy it, it's really worthless. So you're devaluing the ESOP, the intent of the ESOP, as well as participant account balances. During the early years, this repurchase obligation is going to be minimal, so it's manageable, I would say. However, as you mature and grow, and as your ESOP transaction debt starts getting paid down, or debt, whatever you took to finance this transaction, is stock accounts grow, this repurchase obligation is also going to grow. And one of the ways that you manage that as an employer is doing what we call a repurchase liability study. Again, for your newer ESOPs, you probably heard us negotiating this in your term sheets. This study is very company specific, so it will be different for probably every single one of you listening in today. It's going to look at specific company circumstances. So census information, for example, do you have an aging workforce? Do you have a younger workforce? Do you have a lot of turnover? Do you have a lot of capital expenditures coming due that you need to sort of prepare for cash flow purposes? So that study is going to look at your specific company circumstances, as well as your plan document. What are your distribution provisions? And it's essentially projecting the liability to satisfy distributions and diversifications as they come due, while also managing the company's cash flow that's needed for other things that are non-ESOP related.
Great, thank you, Kristy. Anybody want to add anything to that? Yeah, go ahead. Neil, I think you're muted, but go ahead.
Yeah, I was waiting to hit the button before I spoke.
There you go. Very good.
Two things. One, I think Kristy mentioned cash. Now, it doesn't mean you have cash on hand at that very, you ultimately need the cash to pay it out, but the ability to fund it is really critical. So, for example, if the repurchase obligation shows that in 2024, the company may need $2 million, you don't necessarily have to have $2 million, today, but you have to have the ability to generate the cash flow through your earnings, or even the ability to borrow that money. So I think that gives you a little bit more comfort that way. And the other thing I want to quickly add is Kristy mentioned diversification. Maybe not everyone understands what that is, but that's the ability of a participant when they have been a participant for 10 years, not an employee, participant for 10 years, and they reach the age 55 and older, 10 and 55. That is the point in time when each participant has the right to sell up to 25% of the shares in their account for up to 5 years back to the trust, and the 6th year, 50%. So that's what the term means.
Thank you, Neil. And both Neil and Kristy touched on repurchase obligation study. So John, I want to kind of throw this over to you. Can you tell us what is a repurchase obligation study, and when should a company run its first study?
Yeah, that's great question. And when we talk about forecasting this liability or trying to get your arms around it, the only way to do that is to really do a study. And what that means is you're taking, like Kristy said, your specific demographics, your population, and you're making some assumptions on stock value growth over time, as well as contribution levels and turnover of your population, retirements, and diversification when it becomes available. But you are projecting that into the future. So there was a mention of a $2 million potential liability in 2024. How would you know that? Well, it's because you ran a study and you forecasted based on your specific situation, your plan document, your provisions, and your population of employees. And you forecasted what their balances would look like into the future. And then what would be the actuarial decrements, the turnover tables that you apply to your population, and the retirements based on your actual employee dates of retirement. And you come up with, sometimes it's a 10-year study, maybe it's up to a 20-year study. It's a look into the future of what that cash flow need might be. So that's why you're doing that study, is so that you have plenty of time to plan for that cash flow need, like Neil said.
And John, I think I've seen some companies that when they have a study done, they might have 4 or 5 iterations, right? Where they try different assumptions and scenarios to make sure that they kind of have the range of where they think that obligation will be.
Yeah, that's absolutely correct. And when we say this is assumption ridden, it certainly is. And so you're right, Jeff, that some companies will run a study, call it a base case scenario. Maybe that's with a 5% stock value growth. And then some companies, then they may do a probable case. Maybe it's a 10% stock growth. And then maybe it's depending on your perspective, worst case scenario, best case scenario, a 10%, 15% stock growth. Right. And so they'll run various studies based on various stock growth assumptions. Other times, yeah, go ahead.
I'm sorry, it doesn't all have to just be share price though either. It can be assumptions about when are people going to retire, or how much are people going to diversify or not diversify, all kinds of different assumptions, right?
Yes, and I think oftentimes the big toggle between studies is really, how are you going to handle that repurchase obligation? Are you going to redeem the stock? Are you going to recycle the stock? And also your distribution provisions. Over time, you may start out initially with very conservative distribution provisions. You might delay for 5 years and then pay out in installments. But as that stock value starts to grow because you're paying down debt and you've got maybe more cash flow available to pay off this liability as it comes due, you might accelerate those distribution provisions so that you're buying stock out at a lower stock price today than a future higher stock price in 5 years down the road. So
right.
Very much multiple studies done by the same company in the same year, but you're spot on, because they're assuming different sets of assumptions when they run those studies.
Perfect. Yeah, go ahead.
I was going to say, John touched on the distribution provisions of the plan, and just to put this in kind of context for the attendees, when we're doing your transaction, everybody's focus is on the transaction documents and the term sheet, and then the plan document sort of falls by the wayside, and it's like the last thing anybody wants to really deal with. But the distribution policy that we're discussing at this transaction level and that we're implementing at the outset is extremely important, because we don't want the distribution provisions of your ESOP to be drafted in such a constrictive way that you can never change it, and then you're stuck with very large repurchase obligations in the future, because at the outset, at the initial ESOP implementation, somebody didn't draft flexible distribution provisions. So for all listening, I think I know all of us on this call and most attorneys, I would say, draft distribution ESOP provisions much differently than your 401k. And it's done on purpose because you have a repurchase obligation that's in the back of our minds when we're designing these plans, and that distribution policy, distribution provisions in your plan, those are going to sort of dictate your repurchase obligation as you mature as an ESOP. So I just wanted to mention that so everybody can put this in full context.
Great. Thank you, Kristy. And how you buy those shares back, that's a whole nother subject that we'll have to jump into on another episode here, but I'm sure we could spend an hour easy talking about that. And John, I don't know if I heard you say it or not, but when after the transaction's completed, when should a company start thinking about its first repurchase obligation study?
Yeah, and I think Kristy touched on this a little bit. It is going to be pretty minimal early on for various reasons. Because of the vesting, sometimes companies will start vesting over at zero, the day one of the ESOP. But certainly the share price is going to be low because of all the debt that the company took on for the transaction. So, and you don't have multiple years worth of allocations dropped into the participant accounts yet. So the numbers are going to be very, very small from all of those reasons. So I would typically see maybe that first study being 2 or 3 years out, typically. And then I think it's probably a best case or a best practice to run a study every couple of years, and maybe more often, well, not maybe, but more often than that, if you have significant changes. So we said this is an assumption-based project. And if you make assumptions and you run a study and 6 months after that, things change dramatically, like you laid off half your workforce or you made an acquisition, just things that are drastically different than what you assumed. I would say, even though we're only 6 months after you ran the last study, you need to run another study. So that would be kind of my thought on the frequency and timing.
Thank you. All right. Good.
Yeah, I'd
good
also
advice.
like to add to support both what Kristy said and John said. I mean, from the trustee perspective, we think this is so important that we negotiate that in the term sheet that a repurchase study be done every 3 years typically. Having said that, the initial repurchase study liability, the initial study is really not going to show much, but we want people to get in the habit of doing it. And so, you can start to do it and then you can understand
Right.
how to modify the assumptions going forward.
I think that you almost touched on it, it's almost practice at first, right? That first one might not be quite as meaningful, but the more, as you say, the more times you do it, the easier it becomes to start thinking about what are the assumptions and how does this affect us? So, Neil, do you have any other advice related to preparing a study?
Matter of fact, I do.
All
I
right.
happen to have some things I want to share. Number one, don't do it on the back of a napkin. Now, I say this and you can laugh, but trust me, I've seen it done that way. Now, it may not be in the back of a napkin, but it's on a piece of paper, and it's difficult to replicate if you're doing it that way. So that's number one. Number two, again, we use the word estimate. Please keep in mind this is an estimate, but in saying that, we want you to estimate almost on a worst case basis. Now, what I mean by that, and John's talked about the share price more than once, if you look at what your share price increase has been for the last 2 or 3 years, you probably have a pretty good idea what the trend is. Well, increase that for the purpose of the study. Because what we want to ultimately determine is, okay, what's the worst case scenario for the repurchase obligation? Okay, it's not the best case, what's the worst case? And so again, future share price, be more aggressive. Assume that the diversification, everyone's going to maximize that. Assume people retire at the actual retirement age, and assume a higher level of turnover. Those are my pieces of advice. And work with a professional that knows what they're doing, like John.
Good. Great advice. Thank you, Neil. Corley, I'd like to jump over to you for a minute if I could. And, I've heard a couple people mention that using, time to start buying back shares over that 5-year period can be a way to help manage that repurchase obligation. What are your thoughts on that?
Yeah, that's exactly right. So I think as a lot of you look into your plan documents, you may find that there's an option to pay out retiring participants over time, right? I think what we see often is maybe a 5-year period, and there's an advantage to that. There's a reason that the legal teams have drafted language in there. For example, if in any one given year you have $100,000 of repurchase obligation that's triggered, having the option to pay that out over a 5-year period can dramatically reduce the burden on cash, right? Cutting that from $100,000 that year to $20,000 per year. It doesn't mean that you can take your eye off the ball. That can stack up and compound pretty quickly as retirement events continue to take place. But for those of you that have those provisions in your plans that allow for payouts over time, that can be extremely advantageous as you manage cash burden.
Great. Kristy, I'm going to ask you this. How do companies finance this repurchase obligation? Where does the cash come from? How do they do that?
That's a great question. And I think all of us can attest that we all get these questions pretty frequently. So we talked about knowing that you have a repurchase obligation. We talked about the fact that you manage that obligation by doing these repurchase liability studies. So when you get that information, what do you do with it? That information is going to tell you, as Neil said in the example, in 2024, I have a $2 million liability. I'm assuming that I'm going to have. So how do I get this cash? Some companies, and I see this done maybe early on in the ESOP life cycle, they pay as you go. So instead of a $2 million liability, let's say it's $10,000. So next year I got to pay out a group of people at $10,000, I'm assuming. Well, I have $10,000. It's part of my cash at my corporate level. I'm just going to put that in the ESOP and use that to pay people out. Pay as you go, as I said, it's usually done early on in the ESOP when your liability is manageable. It's also a good tool to use if you're recycling or redeeming. I know that we've all thrown out recycling and redeeming, and you may have questions about that. We're happy to answer those at the end about what that means, but pay as you go can offer you flexibility to redeem or recycle. The other things that we see are some companies create what we call sinking funds. What essentially that is earmarking money for the repurchase obligation. Some companies do that in the ESOP itself. So $2 million, I'm going to put $2 million in. What does that mean for the company to do that? Well, I do want to reiterate, and this is important to keep in mind, it's reducing cash assets that your company has. So it's going to be it's going to impact value because you're taking cash out of the company, you're putting it into the ESOP. Now, when you're doing that, that money can't leave the ESOP again. So when it's in there, it's in there. And if you have some unforeseen, unexpected corporate expense, you can't go into the ESOP and take that money out. So you put money aside to satisfy repurchase obligations in an ESOP sinking fund. If you don't like the idea of putting money in the ESOP and knowing that it can't be touched if it's needed, you can do a corporate sinking fund. So you're just basically, again, setting money aside, earmarking it for repurchase obligations. That is going to stay on your balance sheet. That's assets at the cash level. So that's one of the benefits of doing it that way. This also gives you flexibility on the redeeming and the recycling of the shares. When we talked about the ESOP sinking fund, I usually see that done when a company knows I'm just going to continue to recycle my shares. I'm not redeeming. And that's why you would want the cash in the ESOP, because you're recycling shares and it just keeps going in the circle in the ESOP. The other thing that I've seen, and this is it's a method, but I don't want people to use it necessarily unless you need to. Some people get external debt. And I see that very limited circumstances and very specific circumstances. It's if there's a large account balance that you didn't foresee coming due immediately, and for some reason it did. This would be a way to fund a repurchase obligation in one or 2 years. It's not something that you want to continuously do. I mention it because there may be a time that you need it. If you have ability to get credit from your bank or financing from your bank, you can certainly utilize that, but it's not something when Neil's meeting with you every year to say, tell me about your repurchase obligation, how are you managing that? You don't want to tell him, I take bank financing out every time I need to deal with it. The other thing that we see is corporate owned life insurance. So that's basically getting life insurance on some of your key employees. This is obviously for a death benefit. So if somebody dies, that policy goes to the company's benefit, and they can use it to fund very large account balances. I also see corporate owned life insurance used when a company knows I have no desire to sell. I want to keep being an ESOP. I have a very long-term goal of being an ESOP. I have high account balances because of that. And a corporate owned life insurance policy is something that is used usually not solely, but it is something that's usually combined with a sinking fund or pay-as-you-go method to fund that obligation should you need it. And it's usually, like I said, it's usually seen as a way to cover very large account balances when you are a very long established ESOP. And if you ignore it, which I know, Jeff, we're going to talk about that, but if you ignore it, because I think they sort of tie together, ignoring it or mismanaging it, or not really taking it seriously, I guess you can deal with your repurchase obligation by selling your company, which nobody wants to do. You can liquidate your company, file for bankruptcy, but keep in mind, this is triggering, and I know Neil will have thoughts on this too, but this is triggering fiduciary liability. It's triggering board of director liability and risk. It's basically saying, I can't manage my cash flow. I can't pay out my participants. It's probably going to be hard for a company in that circumstance to say to a bank, I have this very large account balance and these account balances that are coming due and I don't have cash flow to pay for them. Can you help me? That's not going to look too good. So ignoring or mismanaging the repurchase obligation, I think, can have dire consequences. Sale, company becoming insolvent. While this is all going on, keep in mind your employee morale is going down. People are not motivated. People are probably going to start wanting to leave the company and look for other jobs. It has a very negative impact. So you want to, again, get your arms around it, manage it, know what's there, estimate for, be realistic in the estimates of assuming everybody's diversifying, assuming when people reach normal retirement age, they're going to leave, and estimating the rest of that, because you don't want to find yourself in a position where you're forced to sell or you're filing for some sort of bankruptcy to sort of refinance debt.
Great, thank you. Neil, have you seen any of those situations? Have you seen ESOPs that have gotten themselves in that bind, and what have they done?
Oh, Jeff, none of my clients, that would never happen. Having said that, I mean, I wish that was true. The good news is that, we more than encourage our clients to do the repurchase liability studies. And I think going back to what John said is, where do you see the need to do this beyond the requirements? Number one, you've got the demographics of your workforce are older workers who have been there a long time. They've got larger account balances. Number two, you combine that with an increasing stock price. I mean, that's those two factors, a scenario for disaster if you're not planning for it. And again, another way that there might be kind of a little bit of a notice of a challenge, and Corley, maybe you can address this. Sometimes we see valuation firms adjusting the discount for lack of marketability, which maybe not be the most appropriate method. And instead of using a standard 5%, they may do 7.5% or 10% if there could be a funding issue. Corley, do you want to comment on the use of that or lack of use of that for the repurchase liability?
Yeah, that's exactly right. So within the valuation world, when we're valuing a single share in a privately held business, you have to think through, well, what is the marketability of that share, right? And marketability is defined by how easily can the value of that share be converted into cash. So a business that has done an appropriate job of planning for these repurchase obligations and demonstrates good cash flow to be able to support these repurchase obligations has an ability to convert these shares quickly into cash. And so that's considered very marketable. And I think a lot of you are probably familiar with seeing perhaps around a 5% discount. I think to Neil's point, when we run into situations where these shares cannot be easily converted into cash, and the strength or the health of the company or the health of the balance sheet does not support or support an easy conversion into cash, then higher discounts may be appropriate. So those, for any of you that do see discounts north of 5% in your annual share valuations, that's likely what the valuation group is signaling to you. And if you haven't had a conversation around that, I would encourage you to do so.
And Corley,
I'm sorry,
Go
Jeff.
ahead.
Another thing that we've also seen too is kind of the morphing of what we've been describing as repurchase obligation studies to sustainability studies.
Mm-hmm.
And what I would say is the repurchase obligation study is level one. It covers all the issues we're describing, but it doesn't necessarily lay out a lot of strategies to deal with what the liability is. And it also may not take as great a look in depth for the demographics of the employees and look at the balances. So for example, if you have 20% of the employee owners have got 60% of the account balances, I mean, that's something that doesn't automatically pop up in a repurchase obligation study. And so again, a lot of firms that have been doing RO studies are now morphed into doing sustainability studies, which I think are really, really helpful, more than just an RO study.
Yeah, for sure, because that's going to allow you to look at your future cash flows during one of those sustainability studies and say, okay, where is that cash going to come? Now we know what the liability is. Where are we going? How are we going to fund it? And you're right. That's very helpful, Neil. Thank you for that. Corley, I heard Kristy mention earlier that if you create a sinking fund and you go ahead and put that cash into the trust, which of course there's some complications perhaps there too, depending on the size of what you're trying to put in, but we won't even go into that. But just she mentioned that your valuation may go down as a result of that. Can you talk about that a little bit?
Yeah, absolutely. So, a component of your valuation is obviously the value of the company. But I would make the analogy that that's similar to the value of a house. Once you value the house, you've got to factor in, okay, well, how much debt sits on that house and how much cash sits in that house. And so anytime we're going through a valuation, we're going through that same exercise for the business. What is the value of the business? Is there debt on this business? And how much cash sits inside the company? So as cash departs the business and flows up into the trust, that conceptually will have a dollar for dollar impact. A dollar leaving the business would, all things being equal, result in the value being worth a dollar less. Now that's not an overly concerning thing as the business builds cash annually. That is incremental cash that year that was put on the balance sheet from the performance of the business that year. So it's not necessarily true to say that value would be declining, right, as you're managing that cash and moving it to the trust. But that is the direct impact that it would have on a per share value, and certainly something to be mindful of.
Yeah, and I also like to follow up on that point that Kristy mentioned this earlier. Do not put excess cash in the trust. The trustee will not give it back. And it's not just a preference, the trustee cannot give the money back, except if there is a contribution error and there's too much money was contributed, basically it was an error, because the trust is not a place to put excess cash.
Yeah,
good point.
I would emphasize to emphasize that point as well. Businesses go through cycles. There's years where businesses perform extremely well, and there's always going to be some challenging years where some unexpected events or activities come up. And I think that's particularly important with what Neil and Kristy have mentioned on this presentation so far is once that capital goes to the trust, it's gone, right? And the company no longer will have access to that in the event that there's some sort of turbulence in the business. And so that's definitely something to keep in mind as you be strategic around whether or not you shift the capital to the trust or keep it within the company.
And one thing and I think everybody might be getting the gist of this, but this obligation is something not to take lightly, and it has different implications based on how you're handling it and managing it and financing it, if you will. And so it's important to bring in your trustee, valuation firm, attorney, TPA, but all of your professionals that help you on ESOP matters. This is probably one of the topics that I think touches upon what everybody is doing that's helping you in your ESOP life cycle. And so it's important that these conversations, if you want to talk about, well, how do I manage this repurchase obligation? Should I put it in the ESOP? Should I just pay as I go? Should I get insurance? What should I do? Those are conversations that you might want to just bring in your what I call the professional ESOP team, because all of us can offer some sort of comment or recommendation on what might be best for your specific circumstance.
Yeah, and so I will say from my former life as the CEO of an ESOP company, that's exactly what we recognized that we had a significant liability in front of us, and we pulled the team together and said, okay, how do we manage this? And it was very helpful. What would you consider the single most important factor in understanding the repurchase liability and sustaining the ESOP for the long term?
that for me, Jeff? I'm sorry.
Yes, John. Yes, I'm sorry.
All right,
Yep.
perfect. Yeah, I think, and Neil touched on it too, kind of that evolution from a repurchase obligation study to a sustainability study. I think all of you on this webinar are interested in sustaining your ESOP for the long term. And one thing that I don't know if it's a caution, I think it's more of just an awareness. Not every company is built the same when it comes to repurchase obligation, planning for it, and sustaining your ESOP. Some companies are going to have an easier time sustaining the ESOP. And what I mean by that, they are going to have all of the tools in the tool belt available to them. Other companies, just based on their circumstances, might not have all of the tools in the tool belt available to them to sustain the ESOP long term. And the single most important factor, I think, in determining, hey, what kind of company am I right now out of the chute and going forward? Am I going to be on one end or the other? And look at the ratio of your enterprise value to your compensation, your eligible compensation. And so if you've got $100 million company and you've got a $10 million payroll, let's just say that's a factor of 10. Compare yourself to another company that maybe is more like a 1-to-1, $10 million company with a $10 million payroll. So think manufacturing first and maybe a service company second. They are going to have different experiences trying to sustain their ESOP. They are going to employ different strategies because the first company is going to be limited. It's not to say they're a bad company. Some would say, hey, that's great. They got 10 times value. Their company's worth 10 times what they put in for payroll. Just means that they maybe have overseas employees that aren't eligible for the ESOP, or they could be more machine-based instead of people-based. Whatever the reason, the dynamics of this liability, this obligation, are based on the value that's allocated to participants. But as we talk about putting contributions into the plan to satisfy that and recycle the shares that come due for distributions every year, that is a function you're limited based on payroll. So we might have in company number one, a really high liability. Let's just say it's 7% of the payroll or 7% of the allocated stock. That's, if everything's allocated, that's $7 million. But they have $10 million worth of payroll annually. So if they put a contribution in, that would be 70% of their payroll. They can't do that under the law and deduct it all. They have a lot of penalties. So they're not going to use that strategy. They're limited. Whereas the other company that's a 1-to-1 ratio, it's a $700,000 liability, and they could put a $700,000 contribution in, and it's 7% of pay. That's within the limits. They've got that strategy available to them. So I don't want to get into too much of more than that in the weeds, but just kind of understand where you are on that spectrum of enterprise value to compensation. And the closer you are to 1-to-1, the easier it's going to be to sustain your ESOP in the long run, and meaning that you're going to have all of the tools available to you. If you're on the other end of the spectrum, closer to 5 times or 10 times or even more, it's going to be a little bit more difficult. So That's all. It just means that you got a plan, but you also have to understand maybe where you are on that spectrum.
Well, John, shouldn't that be addressed when the transaction is put together? I mean, that issue is critical, and it's critical enough that certainly the trustee wants to understand what the liability could be. And the way that we certainly see this being impacted is lengthening the loan of the ESOP note.
Absolutely.
And
Yes.
we've agreed to loan terms where you have the 10-to-1 ratio of, value to employees, going 40, 50 years and beyond. But some people sitting in this room hopefully don't have that issue because it was dealt properly by the great advisors that worked on their transaction. But if they have a shorter loan, and this is also another way to address it, that loan can be refinanced, so to speak. I mean, it isn't done often, but I mean, as a trustee, we've been involved with situations where, that benefit level was getting way too high for a variety of reasons. And so we've then entered into a negotiation with the company to extend the terms of the ESOP note, which is not done often, but it is a strategy.
Yeah, absolutely. And I think I agree. Everyone on this call in this webinar are probably in really good hands with how your transaction was structured. I give you caution as you maybe sit next to other companies when you go to a conference and you hear stories about how they're handling or they're able to do this with their ESOP. Just know that you might be different than them, and what works for them might not work for you, depending on, maybe this factor that I mentioned.
Good advice, John. Thank you. Neil, who should people be reaching out to? What professionals are going to help them prepare a repurchase obligation study or even a sustainability study?
Well, clearly they need to reach out to John. But putting that aside, and the category, the reason I'm saying John, because I've worked with John and his firm, they do a great job. So a little bit of a plug for them, but the category that principal fits into is third-party administrator. So I think initially people should look to their TPA, but not every TPA offers this repurchase obligation study. But you start with the TPA. I think that historically there's been a firm, ESOP Economics, that's one of the things that mainly thing they do. And so they have been involved with repurchase obligation studies for decades. And they have, and they can do, and I suspect I'll let John answer this question. They could do as much of it as you want, or as little as they want, in terms of you can purchase their software, and I'll let John address it and what happens to their firm. With ESOP Economics, you used to be able to purchase their software, do all the work yourself, or you could have them do the study for you. And the third category of professionals that's been doing this is valuation firms. And valuation firms have been probably, from what I've seen, have been doing more of the sustainability studies, not just the RO studies. So John, maybe you can describe kind of how you work with your clients to do a RO study.
Yeah, I think you're spot on, Neil. I think the first place to look for help is with your TPA, whoever that is. They may help you in different ways from other TPA firms, but that's probably your first step. We do offer that service to all of our clients. We give them access to a forecasting tool that they can use to forecast and prepare studies themselves. We certainly give them a lot of support along the way in doing that, but sometimes we are asked to run a study for them, which we will do as well. But I think your TPA, start there. They should be able to help you.
Great.
And John, you mentioned you do this for clients. Is this available to non-clients as well or not?
No, our tool is only available for our clients, just based on how it's built and where it's housed on our website for clients, on the plan sponsor website.
I just want to remind attendees, as we're starting to move toward the end of our panel discussion, that please use the Q&A feature of Zoom to send any questions that you might want us to answer here in the last part of our presentation today. Corley, I wanted to come back to you. An automatic sale of stock at departure, how does that help manage the repurchase obligation?
Yeah, so something that I think has been talked about on this presentation that impacts your repurchase obligation is the growth of the share price, right? As John has walked through some of the underlying assumptions, some of the examples that were given was share growth of 5% a year, 10% a year, 15% a year. I think Neil referenced suggestions on, hey, when you're doing these studies, let's select growth rates that are even higher. And so what some companies have is instances of former employees that own shares. They're no longer working for the business anymore, but they still own shares. And within the plan documents, you can draft a language such that if there is a departure of an employee, that those shares are automatically repurchased or automatically redeemed. One benefit of doing that is it locks in the price at the departure date. So if there's an individual that leaves the business and the share price is $100 at their departure time, it's locking in that share price at the departure date and not prolonging the payout from when shares may be worth more down the road. So I think not every plan may have that in there, but connecting with somebody like Kristy to review that to see if you guys have employed that type of strategy, it can be advantageous.
And so Corley touched on something there, Kristy, and perhaps you can address this, but if a company goes along and realizes that something related to its repurchase obligation is a result of the way they structured their plan originally, can something be done to the plan to fix that, or what do they do?
So I can take this one. So if they wanted to add, so Corley mentioned this concept of when people leave, instead of letting them be invested in company stock at their departure, where they can, assuming the stock is increasing, they're going to get that value year after year after year, and they're not working for you any longer. They're at your competitor. So you can buy back their shares and put them in cash. That is something, and I can say in our plan documents, we put that in our plan documents. I think most ESOP attorneys do that provision. If you didn't have it and you wanted to implement that, that is something that you could do. This isn't really a legal issue, but when you make changes to your distribution policy and taking people from cash or taking people from stock and putting them into cash is part of a distribution policy. When you do that, my one recommendation would be, even legally we can make that change, not a problem. We can add that in. However, you might want to be proactive in explaining to your participants so they don't get angry and call Neil and complain about why they don't have stock anymore. That's why they didn't take a distribution, because they wanted to be invested in stock. So I think the communication that companies have with their workforce on distributions are very important. Now, the other side of that coin would be, if your plan was drafted that everybody's getting lump sum distributions 1 year after they terminate, well, we get into what's called, under the tax code, anti-cutback rules. And so you can't go changing that to make it more liberally drafted. So when you lock yourself in, your plan provisions are very important to make sure you're not locking yourself in and that they can be changed. I can always say, I'm going to pay in 5-year installments, and then maybe for some reason you decide that you want to do in a lump sum. That's fine, but you can't go from, I'm going to pay you in a lump sum with 1 year and then do 5-year delay, 5-year installment. That's getting into territory we call anti-cutback. That's a big no-no in the eyes of the IRS. And so that's why these distribution plan provisions are very important, to make sure that they're liberally drafted so that you have as much flexibility as you can, because that's going to help sustain the longevity of the ESOP.
This last question I have is, I'm going to direct it first to Neil, and that is, what's the role of board of directors and the trustee in dealing with repurchase obligation? And then I'm going to bounce that back to Kristy and ask you, what are the board and the trustees' obligations as it relates to that? So Neil, I'll let you go ahead first.
Yeah, I think my answer is going to cover some of what you've asked Kristy to respond to, because I think they're absolutely linked.
Yeah.
So the board of directors ultimately is responsible for the repurchase obligation, period. There's no question about that. They are ultimately responsible. Having said that, they're not going to prepare the study. They're going to have the CFO prepare it. The CFO is probably going to be the one that's engaging principal or some other firm. But where the board comes into play is that they need to be aware of this obligation. They need to make sure the study's getting done. They need to see the results, and they have to understand them, as well as ultimately develop a plan for how to fund it. That's the board's obligation. As a trustee, a lot of what we do is oversight and monitoring. And so if the board has not taken those steps, we need to gently remind them to do that. I think the biggest impact is that we also want to make sure that, let's say that the think the repurchase obligation studies may be a little fewer pages than the valuation report, but not much. My point is it's lengthy. It could be 40, 50, 60 pages. No director is going to go through all of that. And so there needs to be an executive summary, and that whoever has prepared that report, an executive summary, needs to go through it carefully with the board, make sure they understand what that obligation is, and hopefully share with them some strategies for how to address it. And I think the role of the trustee is not only to make sure those steps are taken, but also to make sure that the board does truly understand what this means to the company. And, the strategies that are being recommended may be confusing. I mean, we talked about several things already during this presentation. It's not easy to follow. And I quite frankly want to make sure that the board understands all of the options. It's their choice to which strategy to follow, but they need to understand, the strategy and the impact.
And one thing I'll add, I don't have anything to add to what Neil said. He's absolutely correct. And it is a board obligation. And given that most of the audience is a newly formed ESOP, I'm glad that you're all hearing that, because we do have, we've seen some very mature ESOPs think that that's the trustee's obligation. And so they've just not really paid much attention to it. And they think the trustee's doing this. So that is not true. It is the board. This falls on the board. You need to manage and know and make sure that this is getting done. What is the repurchase obligation? If Neil or your valuation firm asks you an annual update time, what is your obligation? You should be able to answer the question. So it is a board function. And I just want to stress that because it's important, and not surprisingly, a lot of companies don't know that. And I think it's important that they do, because that's when you get into the not managing it and not being prepared.
Yeah, one question I'd like to ask Corley, and I guess everyone on the call too, is that on rare occasions, we've seen a valuation report that they actually take the company's repurchase obligation liability and adjust enterprise value for that liability. I don't like that approach. I think it's overly aggressive. I think it reduces the value per share in ways that are not appropriate. And the argument against that, doing it that way, is okay, you've got the liability, but it's not booked on the financial statements. It's not a liability for reporting purposes. So Corley or John, what would you say about that issue in terms of, do you think it's valid to have that liability in the valuation?
Yeah, Neil, great question. So our firm doesn't take that approach. It doesn't mean that if any of you are working with a valuation firm that does take that approach, that it's wrong. I think there is a position to be taken as to why they would want to include it. However, our position would typically be that our goal is to value a single share. If the business were to be sold, what is that share worth? And so that's our biggest focus. That obligation would not go to the buyer. They would not penalize the value of the business for that obligation. The proceeds in the event of a sale of the company would be ultimately what would be utilized to pay everybody their portion of their allocated shares. And so that's the logic that we take. We talked about this earlier. In the event that we feel like there is not sufficient reserves to buy shares from participants, we may see an adjustment to the discount for lack of marketability. I think if you're working with a valuation group that is incorporating this obligation within the share price, effectively that's what they're attempting to accomplish, is that challenge of conversion into cash easily. But so that's the reason why you may see it. There is logic behind incorporating it in there. But that's also an explanation for those of you that do not see it, why valuation firms like ours don't take that position.
Thank you. So just we've only got a few minutes left. There were one or two questions that I want to take a look at, and I think, Neil, you answered a specific question to somebody that asked it in the chat area, but I think it'd be good for everybody to hear. It's not necessarily a repurchase obligation per se, but there was a question about diversification and what are the tax implications when people diversify? Are they going to get a 1099? What happened? Where do those funds go when they diversify?
Yeah, the answer is that it's not taxable so long as it is put into another a qualified retirement plan. Most plan documents say that the funds from the diversification go into the company's 401k plan, assuming they've got it. Clearly not taxable at that point. And they don't also give the option of the participant to take the funds personally. And the other way, of course, is if they do take the funds personally, they still have the opportunity to open a self-directed IRA and put all the funds in there, and then it also would not be taxable.
Great. Thank you. I think we're getting relatively close to the end here, and I do want to just cover a couple of things. We will be sending out an email after this session is over to everyone that has participated today. We'll be looking for feedback on what you'd like to see in the future and what you thought of this event and how we can make it better. There should be a poll popping up on your screen. If you could just take a second and answer that, that would be very helpful. The email will also include contact information for all of our panelists today, so that if you have a specific question or you think of something later and you'd like to ask somebody, please feel free to reach out to any of them. I know they'd be happy to take your call and help you in any way that they can. So on behalf of Lazear Capital, I want to thank all of our panelists, first of all, for their expertise and knowledge and wisdom that they brought today. I think we had a great conversation, and I hope that people that participated and listened in today found it helpful, and we're here to help in any way we can. So at that, is there anything else any of our panelists wants to add before we sign off? No. Okay. All right. Well, great. Thank you so much for your help with this, and thank you to everyone for joining us today. Take care.
Thank you.
So long.
Thank you all.
Bye.